office vacancies hitting an all-time high record in the second quarter at 20.1%. It is the first time the sector has ever eclipsed 20%. It's according to a new Moody's report. And with us now is the co-author of that report, Tom LaSalvia, head of CRE Economics at Moody's. Tom, it is good to see you. So look at this Q2 preliminary trend report, Tom. You do say, listen, the office sector, record vacancy rate, 20.1%. Where does that rate go from here, Tom, in the next, let's say, 6-12 months? And what factors, what variables does that depend on?
Yeah, unfortunately, for office property owners, that vacancy rate continues to go up. Some of our most recent research shows that with remote work really here to stay, we could see a 22 to 24% vacancy rate as at the peak of distress. That's likely to hit sometime in 2025, maybe even early 2026. So there's still a couple of years of accelerated distress as this plays out. One of the key variables here, it's going to be, well, office employment, of course, and we know that the labor market is beginning to soften. And another key variable here is remote work. And remote work, as I said before, it is here to stay, at least at some level, right? I think there's still a trial and error period that's going to last multiple years. But we know that square footage per employee is going to continue to drop.
And Tom, when you talk about a peak vacancy rate in office of 22 to 23%, I mean, just so people know, you said in the second quarter it was about 20%, so still an increase from there. What then is the long-term vacancy rate, right? Like, in other words, how long can it stay at 22 or 23%? Is that the new normal?
It's a great question. The way we're thinking about this as obsolescence, that there is a good 10 to 20% of office buildings out there that really just will not be able to compete in this new era of remote work, this era of new offices, this era of new, let's say, centers of power in terms of where office-centric locations are. Right? I mean, you're getting migration into the Sunbelt. You're seeing even within metropolitan areas like New York, certain submarkets doing much better than others. And so what you're left with is 10 to 20% of obsolete offices that are going to have to find some new life in this new era, right? They're going to have to go the way of a lot of these Class B and Class C malls over the past 30 years.
And do you see that? I mean, that was one big trend, Tom, that was often talked about, that you would see office buildings, repurposed as, for example, residential buildings. I mean, is that, when you do your research, Tom, is that actually happening? Because it seemed like it would be such tremendous red tape and bureaucracy to make that happen. Or no, is that a trend we're seeing that's actually playing out?
No, well, a combination of both of those things. It is a trend that we're seeing, right? And we've seen it. I think the financial district in New York since 9/11 is a perfect example of how you can take at least older office buildings with smaller floor plates, and you can renovate those into valuable residential real estate. So there is a precedent for that. I think the problem comes in is when you have some of these 1970s, 1980s office buildings where there's not a lot of natural light hitting the center of those buildings. That's where you're going to run into real cost pressures that make it prohibitive to actually go ahead with one of these renovations. And so where does that leave us? That leaves us with a lot of subsidization, a lot of public-private partnerships in order to convert some of these obsolete office buildings from that era.
Tom, finally, I wanted to ask you about a report in the Wall Street Journal today that talked about potential fraud that has elevated the valuations of some of these office properties, that now that the market's pulling back, maybe those are being uncovered. And I'm just curious how much of an issue you think that is in the market, and then how that affects what we're going to see next.
Well, what I can say about this is there's been a lot of extensions, there's been a lot of modification, a lot of work with loans, a lot of non-transaction activity going out there, whether it's from the loan perspective or from the sales perspective. And that has not allowed really any price discovery. So whether there's fraud or not, or cooking of books or whatever it might be, a lot of that's going to have to come out over the next year or two, because again, especially if that building is considered obsolete in this new world, right? Where do we go from there? There's going to have to be some liquidation of that asset, and the truth has to come out about really what are the occupancy levels, the rent levels, what's the income, what are the management expenses, right? What's going on with each and every of these properties? So price discovery is going to be a really big deal because of the distress we see coming over the next year, 2 years. I think we do see a lot more of that price discovery, and we see a lot more of the specifics of some of these properties.
Tom LaSalvia, quite a picture here of the office market. Thanks so much. Appreciate it.
Thank you.